Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And for this week, I think we need to focus on US inflation. Both CPI and PPI data were released last week for the month of June. And both data points surprised strongly to the downside. And if I look at the underlying inflation dynamic, it suggests that there is actually very little inflationary pressure within the US economy. And so on the basis of that data, you would conclude that there's no reason for the Federal Reserve to increase interest rates anytime soon. Unfortunately, the problem with that argument is subsequently the oil prices moved up quite dramatically in response to the US-Iran crisis. And so when I look at the Brent oil price, it's sitting at around $90 a barrel. WTI is close to $85 a barrel. And clearly that is going to cause renewed upward pressure on inflation. And if that sort of price pressure persists, then it's entirely feasible the Federal Reserve will have to hike interest rates before the end of the year. So I think we need to just unpack some of the CPI and PPI data, look at what caused the number to surprise on the downside, and then perhaps discuss where we think the inflation numbers could go for the remainder of this year and into next year. In terms of South African data, there wasn't a lot of data released last week. We did get an update on the mining production numbers, which I thought were terrible. That's for the month of May, and clearly the mining industry remains under pressure in terms of volume of production. They have obviously more recently benefited from price effects, but if I look at the gold and platinum price, it's come down quite considerably in recent weeks, and so you would say that we're going to be a little bit disappointed in the second half of the year in terms of mining tax revenue and in terms of how the mining sector performs. So the second topic I think we need to look at this week is some of the data out of China. We had the GDP number for the second quarter of the year. It was below expectations, but we also had an update on industrial production and retail sales, and I think we can unpack some of that in a little bit of detail. I don't want to spend a huge amount of time on that. So I think for this week, we focus on US inflation and then some of the more recent economic data out of China. So let's start with the discussion of US inflation for the month of June. During the month, the CPI came down 0.4% month on month, which is very significant. It's actually quite rare that US inflation declines to that extent in any particular month. It does happen, but it's not particularly common. The market was thinking there would be a decline, but only of 0.1%. And obviously, most of the decline did relate to the lower gasoline price. We saw the oil price coming down all the way to about $70 a barrel, and clearly that helped to soften the gasoline price effect. But if I look at the detail, the sub-detail within the CPI data, it's very clear that a whole range of other categories also showed a moderation in price pressure, particularly some of the basic consumer goods like clothing, household appliances, watches, jewelry, sewing machines, a whole range of items that are largely imported. Those items actually declined and have moved into deflation. And a lot of that is caused by the fact that while the US has significant import duties, the import duties are not as high as they were immediately after the liberation tariffs were introduced back in April last year. So in a bizarre way, the fact that the average tariff level is lower on a year-on-year basis is helping to soften some of the inflation data. And then other categories of inflation that we have previously been concerned about, those numbers also moderated. So something like vehicle insurance, that's moved into deflation. If I look at used car prices, new motor vehicle prices, those came off. Airline fares declined because of the lower fuel price. If you look at shelter inflation, there was a very modest increase, only 0.1% in the month. So what I'm getting at is that this wasn't caused just by a decline in the gasoline price. It was much broader than that, suggesting underlying inflationary pressure is much more under control. And so when you look at the core inflation rate, it came off to 2.6%. Now, 2.6% is still quite a way away from the 2% target, but it's not ridiculously too high. And so that would give the Federal Reserve a huge amount of comfort. Now, as I said in the introduction, the gasoline price has subsequently gone up. It's not going back to the level it was at previously. So the US gasoline price sits at about $4 per gallon. And if you think during the early part of the crisis, it got to $4.60 a gallon. So it's not going back to the recent historical high, but the increase will cause a resurgence in some of the inflation categories, and clearly that could create additional broad-based inflationary pressure. And so the Federal Reserve is going to want to keep interest rates on hold in the short term. By that I mean the next meeting, as they evaluate how the Iran crisis develops. But you would have to argue that if the oil price remains at these levels, by that I mean over $80 a barrel, approaching $90 a barrel, then in a couple of months' time, the Federal Reserve is going to be more anxious about the inflation outlook. And given that Kevin Walsh, as chairman, has been very strong in saying that the Federal Reserve is going to do everything they can to get inflation back under control, back to the 2% target, then the pressure will build up for the Federal Reserve to hike interest rates. And so that becomes a bit of a risk, not just for the US, but for the global economy, because obviously a lot of other central banks would feed off whatever the US is doing, including the South African Reserve Bank. So I would say it's very unfortunate that there's been this re-escalation of the crisis in the Middle East. I think prior to that escalation, the data was looking a lot more comfortable. People were feeling a lot more assured that interest rates around the world wouldn't have to go up that dramatically. And now there's a huge amount of uncertainty, and I think you're going to see more central banks having to respond to the pickup in the oil price, even if it's only in the short term. And so what we've got to spend a huge amount of time trying to understand is what results in a resolution to the Middle East crisis. How does the Middle East crisis get resolved, and how quickly can that be put in place? Or are we simply saying the crisis isn't going to be adequately resolved, and therefore the Strait of Hormuz will remain mostly closed, keeping the oil price relatively elevated? And that's a significant outcome that matters for the world economy. It matters not just for inflation, but it matters for economic growth over the medium term. And so I think we need to spend some time looking at that dynamic. Otherwise, most countries are going to go through the rest of this year with fairly elevated levels of inflation and upward pressure on interest rates. The second topic is a quick look at the most recent economic data out of China, and we have the GDP number for the second quarter. China brings out their GDP number very quickly after the end of the quarter, and the data showed that the economy grew by 4.3% measured year on year, and that's down from 5% in the first quarter. The 4.3% was below market expectations. I think the consensus was sitting at about 4.5%, and you would say therefore that that's a bit disappointing. The way I would look at it though is, if you take the first quarter and the second quarter, you average and you say, what was the growth in the first half of the year? Then you're looking at 4% growth, and that's pretty much at the midpoint of what the Chinese government has put out as their growth target. They said at the beginning of the year they wanted the economy to grow at somewhere between 4.5% and 5%, and you would say that, yes, in the first half of the year they've achieved exactly that. Although clearly the moderation in growth has to be a bit of a concern. So what's causing the slowdown? In essence, what's going on in China is that consumer spending is fairly lackluster. It's not a recession, but if you look at the most recent retail sales data, it's barely positive. And so clearly the consumer feels a loss of confidence. That loss of confidence has come about because of the weakness in the property sector. And so consumers have gone back into higher levels of savings, and they haven't been particularly aggressive in terms of spending and in terms of taking on additional credit. And that's showing up in lackluster consumer activity. Now, the Chinese government has been trying to move the economy in favor of domestic activity versus external activity, and move in favor of increased consumption growth rather than relying very heavily on fixed investment spending. And so that is a logical shift they would like to achieve, but they've just struggled to achieve that. And it's simply because the Chinese consumer hasn't been particularly aggressive in how they've gone about consuming and shopping and all of those types of good things. Now, you then got to say, okay, so if the consumer's under pressure, where are they getting their growth from? And it's coming essentially from two categories. The one is industrial production. Their growth rate remains close on 6%. And that industrial production is not being consumed domestically. It's being consumed overwhelmingly in the export market. So if you look at Chinese export performance, it's remarkable. We're talking high double-digit growth within exports, and that appears to be sustainable. And that's despite the fact that China is exporting significantly less to the United States. So the Chinese economy has been able to restructure their exports in favor of other Asian economies. Inter-Asian trade is incredibly strong at the moment. And so you would have to applaud the Chinese authorities for being able to shift their focus away from the US and into other countries, particularly in the Asian region, and do that fairly successfully. There's always the possibility that obviously some of the Chinese goods is going through another Asian economy on its way to the United States, and so this is really just a aberration. It's not really a true reflection. But no matter why it's coming about, the export performance out of China has been remarkable. The industrial production's held up well, and that's enough to give them a very solid economic growth. It does make them vulnerable, and that vulnerability is the fact that they rely very heavily on the performance of the world economy and their performance of exports. And if, for example, the high oil price were to dampen down world economic growth in a meaningful way, then clearly Chinese growth would come under more pressure. So it represents a significant risk for Chinese economic performance. I think it's manageable at this stage, but from the Chinese perspective, they would ideally like to have a better mix of economic activity, something that is more balanced in favor of a good mix between domestic consumption as well as export performance. And I think they are trying to put measures in place to achieve that, but clearly it's taken a lot longer than they had envisaged, and they don't want to implement extreme policy measures because it always runs the risk of creating unintended consequences that could then result in some other distortion that they have to then implement additional policies to rectify. So I think solid growth out of China, a little bit vulnerable to what's happening to the global economic performance, but nothing that would really cause a significant concern in terms of financial markets. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorised financial services provider in terms of the FAIS Act. Also, this podcast should not be construed as advice.